Hello, everyone. It's summertime. I hope you're all having an enjoyable summer. Financial markets have been doing quite well so far this year and over the last number of weeks. But we had a couple questions about something that I find quite interesting, and I wanted to do a short video to explain how non-intuitive financial markets can be, and one of the major causes of that. So I'll jump right into what we prepared. And this presentation is mostly about expectations and why they are so important and so often underlooked in financial markets. So one of the hardest things to grasp about financial markets for both people who work in the industry and people who don't work in the industry is that they often move in ways that do not seem intuitive. This is true for individual stocks. It's true for broad stock markets. It's true really across the whole financial ecosystem. The reason that this sort of became topical, we had a couple clients ask earlier in this week when the Bank of Canada raised its benchmark interest rate by 0.25%. They were sort of concerned about what that was doing to financial markets, or sort of assuming that financial markets, the stock market, was lower because that happened. And while it's true that in general, rising interest rates are not a good thing for bond prices and stock prices, the day of the announcement and actually the day after, both of those days, the stock market was up, bond prices were actually up. And the reason for that has everything to do with expectations, namely that interest rate increase was already, everyone really already anticipated it. But it speaks to a larger point that I'm going to get into in the presentation. So looking at our lives in general outside of financial markets, obviously expectations play a huge role in how we feel about many different things, whether that's a trip or a meal or some sort of event. Expectations, you can have a nice meal, for example, at a restaurant, but if you thought you were going to have a really spectacular meal, then you'll feel disappointed because it doesn't meet high expectations. Thinking back in my own life, I've been fortunate enough to go to Italy 3 different times. I love Italy. One thing that I had high expectations of that didn't really meet those expectations was the Colosseum in Rome. It was busy, it was hot, just really thought it was going to be spectacular and didn't quite measure up. On the other hand, there are certain things in life that we had low expectations going into and have pleasant memories because those low expectations were surpassed. And later on that same trip, we went to a restaurant. It was completely empty, which is unusual for Italy. Very low expectations, but we didn't have a lot of other options for lunch, and it ended up being a spectacular meal that we remember fondly. So obviously expectations play a huge role in many different areas of life. Another interesting point here, in 2004, the New York Times interviewed Stephen Hawking, the very famous scientist, and he developed a motor neuron disease in his early 20s that left him paralyzed and unable to talk. So he was in a wheelchair. And I guess during this interview, he was very positive, being very happy. And the New York Times asked, "Are you always this cheerful? How do you keep your spirits up?" And Stephen Hawking responded, "My expectations were reduced to 0 when I was 21. Everything since then has been a bonus." Right? So that speaks to how beneficial low expectations can be. And a couple of examples in the financial markets. One is in 2009. So during the financial crisis, the US stock market declined by more than 50%. And this is a graph that shows the US unemployment rate from 2008 to 2011. So at the beginning of 2008, the unemployment rate was about 5%. That increased to basically 10% a couple years later. And the interesting thing about this is that the stock market actually reached its lowest point in early 2009 and then began to recover. And so on the chart, that's right where this red dot is. So the unemployment rate was about 8% at that point. And things kept getting worse in the economy, but because the market's expectations had gotten so low at that point, even the bad news of more job losses and the economy slowing more, the stock market started to recover. So even though the news was bad, the expectations were low enough that the stock market began to recover. Going back to 2020, something very similar happened during the outset of the pandemic. So the stock market declined very quickly. but actually started to recover in March, the third week of March in 2020. And so here, this chart shows COVID-19 cases in Canada, and you can see that the markets reached their bottom basically right at the beginning of the pandemic. And again, it's because, and we had some clients ask us at that time who were concerned, this pandemic is likely to go on for years. Don't we need to sell a bunch of stocks, or how can you be confident that things are going to recover? And what ended up happening is the news did continue to get worse for months and months after that in terms of number of infections and everything shutting down. But the stock market had already anticipated that, and the expectations were such that the market began to recover even very early on into the pandemic, even though there were still months and years worth of challenges that came up. The third example I wanted to talk about briefly is Netflix, so an individual company. By almost any definition, Netflix has been a massive success. Over 200 million subscribers. It's won awards for its programming. It's revolutionized the way that we consume television and movies. However, if you look back over the last 5 years, the stock price hasn't gone anywhere. It's gone up somewhat and then down, but it's basically back where it was 5 years ago. So if you were an investor over the last 5 years in Netflix, you haven't made any money. And so the point here is that the business of Netflix has been successful during this period, but the stock has been disappointing. And that's because the expectations back in 2018 were so high that maybe Netflix met those expectations, but that doesn't translate necessarily into a higher stock price. So this can happen both in positive ways and negative ways. Sometimes a company is struggling, but if everyone has really low expectations, that can sometimes be enough that the stock price does well. And companies can be doing very well, as Netflix did, but that doesn't mean the stock is necessarily doing well. So this goes back to something that we wrote about in last August in the monthly commentary. The section was titled Better or Worse. The idea being that financial data should never really be looked at as just good or bad. It's always, is it better than expectations or worse than expectations? And so this is part of the reason why forecasting financial markets is so difficult. Even if you get the growth in the economy or a company's earnings or whatever sort of variable you're looking at, even if you can predict that correctly, it's very difficult to figure out what the market's reaction is going to be. And so this also means that the stock market is often not intuitive. So a company might announce that it's growing its sales and earnings very quickly, and the stock price might actually decline because the market was expecting even more growth than that. And likewise, that can happen in the overall stock market where the news might be bad, but if people are already expecting bad news, the reaction might end up being positive, and vice versa. So that's just something really, really important to remember. So with that, that's the presentation that we put together. I hope that that's provided some useful information. And if you have any questions or comments about that, please feel free to reach out. Always happy to hear your responses. Hope that you all have an enjoyable rest of the summer. Take care and bye for now.